were some conflicting signals about the economy's health in that third quarter GDP number. On the positive side, the U.S. economy grew by 2.6%. The biggest contributor to growth came from a narrowing trade deficit, where exports were higher than imports. Another positive is that the economy returned to growth following 2 consecutive quarters of contraction. But it isn't all good news, and the recent GDP number is likely obscuring some fundamental weakness in the economy. The strong trade performance is likely unsustainable due to the slowdown in global growth, as well as the strong U.S. dollar. And U.S. economic activity is also expected to slow in the coming months as both consumers and businesses continue to pull back spending in the face of rising interest rates, inflation, and increased uncertainty surrounding both of those. So there is some irony that the economy is registering positive growth for the first time in 2022 when things in the economy are likely actually starting to cool. The Fed continued to tighten monetary policy and raised the Fed funds rate by 75 basis points, bringing the current rate to a range of 3.75% to 4%. The Fed has raised a total of 6 times in 2022, with 4 consecutive 75 basis points raises. And it remains very likely the Fed will continue to raise rates for the 7th time during its final meeting of the year in December. This current hiking cycle has been one of the steepest in history, and several metrics seem to hint that the Fed might be forced to continue hiking in order to slow the economy and tame inflation. During his press conference, Federal Reserve Chairman Jay Powell took a decidedly hawkish tone, noting that the Fed still had some way to go before the current interest rate cycle is over. He also said that incoming data since our last meeting suggests that ultimate levels of interest rates will be higher than previously expected.
There is significant uncertainty around that level of interest rates. Even so, we still have some ways to go. And incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation.
So to summarize, what Powell is saying is 1, rates will be higher than originally anticipated and likely elevated for a longer period of time. And 2, the terminal rate, the peak Fed funds rate prior to the Fed starting to loosen policy, is also likely to be higher than anticipated as well. The Fed continues to tighten policy because inflation has proven to be much more persistent and remains well above the Fed's targeted range, and the labor market also continues to be tight. If we look at inflation, inflation has come down for the last 3 months from its peak in June of 9.1% to 8.2% in September. However, core inflation, which strips out the volatile energy and food categories, has reached its highest rate in September at 6.6%. And core inflation is important because it gives a sense of how broad inflation has become. Inflation has spread to categories such as housing and services such as medical care, and prices are increasing in more categories than they are decreasing. The labor market also continues to show signs of strength. In the most recent non-farm payrolls release, the economy added 261,000 jobs in October and over 2.8 million jobs since the Fed started to hike in March. While the labor rate did tick up slightly in October to 3.7%, it still remains well below historical averages. Additionally, in the most recent job openings and labor turnover survey, frequently referred to as JOLTS, showed that employers added more than 400,000 job vacancies in September, and this brings the total number of job vacancies to almost 11 million. Most of those vacancies come from healthcare, food service, and the transportation sectors. So labor shortages have helped drive up wages as employers raise pay to attract workers, and it's adding upward pressure on inflation and making the Federal Reserve's job much harder. On average, year-over-year wage increases have averaged around 5%, well above the historical average of around 3%.